The current live price for SoFi Technologies Inc. as of Wednesday, March 25, 2026 is $16.70. This represents a downward intraday movement of 2.62% from the previous session, with the stock oscillating within a range of $16.49 to $17.07 during today's trading hours. While the broader financial sector is feeling the pinch of shifting interest rate expectations, the story for SoFi today is far more specific and arguably more high stakes than a simple macro-driven dip. If you were just looking at the ticker, you might assume this is a standard correction after a period of rapid growth. However, the reality hiding behind this price action is a fierce battle for credibility. Just days ago, a prominent short seller report alleged that the company has over $300 million in unrecorded debt and has been engaging in aggressive accounting practices. The market's reaction today, keeping the price pinned below the $17 level, shows a deep tension between the established bull narrative that SoFi is the future of digital banking and a new skeptical reality that suggests the company's books might be more complex than they appear. While CEO Anthony Noto has stepped in with significant open market purchases to signal confidence, the fact that the stock is struggling to reclaim its 50-day moving average suggests that institutional players are waiting for more than just executive optimism. They want hard data. Most investors see SoFi as a high-growth fintech play that has finally crossed the threshold into consistent profitability. They point to the record-breaking fourth-quarter results from 2025, where the company cleared $1 billion in quarterly revenue for the first time. The general consensus is that as more Gen Z and millennial users migrate away from legacy banks, SoFi's all-in-one app will naturally capture that market share. But here is the deeper take that the market is currently grappling with. SoFi is no longer being valued solely as a disruptor. It is now being scrutinized as a bank. This shift in identity is painful for the stock price. When you're a pure tech play, the market forgives high spending in exchange for user growth. When you have a national bank charter, the market starts looking at your credit quality, your loan-to-deposit ratios, and the transparency of your balance sheet. The recent short seller attack hit exactly where it hurts most for a bank: trust in the accounting. The daily swings we're seeing right now are a direct reflection of this identity crisis. Trading volumes have surged as retail investors on platforms like the Robinhood app or through SoFi Invest itself try to buy the dip, while institutional activity has been more guarded. We've seen some high-level shuffling from firms like Fidelity and Vanguard, who hold massive positions in SoFi. Some of these institutions are using the volatility to rebalance, while others are clearly waiting for the Q1 2026 earnings report, which is now being viewed as the ultimate credibility test. If SoFi can prove that its financial engineering is actually just superior efficiency, the stock has a path back toward $25. If the short seller claims find any footing in the next filing, the floor could be much lower than the current $16 range. What makes this particularly interesting is how SoFi is positioned relative to its peers. When you look at an individual brokerage account or compare it to something like a Schwab Intelligent Portfolio, the value proposition for SoFi is its speed. They're launching products at a pace that legacy institutions cannot match. Recently, they integrated a stablecoin settlement system with MasterCard, effectively turning their SoFi USD into a bridge for global payments. This is the kind of move that keeps Nvidia stock or Apple stock levels of excitement around the brand. But the market today is asking, at what cost? To maintain this pace, SoFi has to spend heavily on member acquisition and product development. While their Rule of 40 score, a key metric for SaaS and fintech companies, is an impressive 68%, the weight of their lending business means they are highly sensitive to the credit cycle. For those engaging in self-investing, the question isn't whether SoFi is growing, it clearly is, with over 13 million members and counting, but whether that growth is sustainable without constant capital injections. We've seen a lot of activity on investing sites lately debating the securitization triggers that some bearish analysts have warned about. This refers to the risk that if the value of the loans SoFi sells to other investors, they might be forced to hold more capital, which would slow down their ability to lend. This is the reality that is currently clashing with the expectation of 30% annual revenue growth through 2028. To get a better sense of how the community is feeling about this specific price point, comment below how many shares of SoFi you currently hold, or if you are waiting for it to drop closer to its 52-week low of $8.60 before entering. Looking at the business model itself, SoFi operates as a three-headed giant. You have the lending segment, which is still the primary driver, the financial services segment, which includes the SoFi trading platform and insurance, and the technology platform, which consists of Galileo and Technisys. The long-term bull case for SoFi often hinges on Galileo. This is their banking-as-a-service arm that powers other fintechs. If you use a competing app or a digital card, there's a good chance Galileo is running the infrastructure in the background. Management wants to turn this into the AWS of fintech. If they succeed, SoFi's valuation should eventually detach from interest rate cycles and move towards the multiples seen in high-margin software companies. However, recent reports show that growth in the technology platform has been slightly softer than some had hoped. While the lending side of the house is firing on all cylinders thanks to record personal loan originations, the tech side is facing stiff competition from the likes of Interactive Brokers and even the Fidelity mobile app, which have both overhauled their digital experience to retain younger users. SoFi is no longer the only game in town for a slick mobile-first experience. This is why the company is pushing so hard into alternative investments, giving members access to private market opportunities in companies like OpenAI or Perplexity AI. They are trying to create a walled garden that offers products you simply cannot get at a traditional individual brokerage or through a standard robo-advisor. From a macroeconomic perspective, the higher-for-longer interest rate environment is a double-edged sword for SoFi. On one hand, it allows them to earn a higher net interest margin on the loans they keep on their books. On the other hand, it puts pressure on their borrowers and makes it more expensive for SoFi to fund its operations. This is why their move to become a bank was so brilliant, because it allowed them to use member deposits as a cheap source of funding. But the market is currently worried about private credit stress. If the economy slows and personal loan defaults rise, SoFi's profitability could vanish as quickly as it appeared. The technical setup on the charts is equally tense. The stock has been in a downward channel since the start of the year, and today's price action at $16.70 is testing the patience of even the most loyal SoFialists. We're seeing a lot of unusual options activity, specifically in long-dated call options with strike prices near $30. This suggests that while the short-term sentiment is bearish, there is a significant group of traders betting on a massive recovery by late 2026. This is the classic expectation versus reality play. The expectation is that the short seller report will fade into the background as noise, while the reality is that SoFi's fundamentals remain intact. As we look toward the future outlook, there are several catalysts on the horizon. The April 28th earnings call will be the most important event of the year for this stock. If management can definitively debunk the accounting concerns and show that their stablecoin-as-a-service model is gaining traction with institutional partners, we could see a rapid re-rating. There is also the possibility of SoFi being added to the S&P 500. For a company that was once a meme stock favorite on the Robinhood app, an S&P 500 inclusion would be the ultimate validation of its transition into a legitimate financial powerhouse. However, the risks are real. The competitive landscape is getting crowded. Companies like SoFi are not just fighting each other, they are fighting the massive scale of Fidelity Wealth Management and the deep pockets of JP Morgan. If SoFi's member growth slows even slightly, or if their customer acquisition costs start to creep up as they reach for a broader audience, the premium valuation they currently enjoy, trading at nearly 30 times forward earnings, could evaporate. In summary, the current price of $16.70 reflects a market that is deeply conflicted. The expectations built around the company's one-stop-shop ecosystem and its high-growth projections are being challenged by the reality of a rigorous short seller attack and the scrutiny that comes with being a nationally chartered bank. We've seen record revenue, the first steps into the crypto stablecoin space, and a CEO who is putting his own wealth on the line to defend the brand. Yet the stock remains under pressure. This is a battle for the soul of the company. Is it a revolutionary tech platform, or is it just a very fast-growing bank with a fancy app? For investors, the central insight here is that the volatility is unlikely to subside until the next earnings report provides a clear answer to the accounting allegations. The contrast between the stellar 2025 performance and the rocky start to 2026 has created a wide gap between what bulls believe the stock is worth and what the market is willing to pay today. If you believe the tech stack advantage through Galileo and